So guys, we are back with another round of portfolio reviews, and I am so excited for this one. We've got a few really cool portfolios on deck today. We're going to go under the hood to take a look at each one. We'll check out all the holdings, and I'll give you my honest thoughts on what I like about these portfolios, as well as what I think could be improved. And as we're going through these guys, please keep in mind that I am by no means a professional. These are just my very amateur opinions, so definitely take them with a grain of salt, and remember that at the end of the day, this is all just for fun. Now, real quick, before we get into it, if you want to have your portfolio reviewed by me in one of these videos, just fill out the form I have linked in the description. And also, as we're going through these, leave me a comment below and let me know what you think about these portfolios. I'd be very curious to get your feedback as well. Anyway, getting into our first portfolio of the day, this one belongs to my friend Neil, who's been around the block a bit. He's been investing so far for somewhere between 6 and 10 years, and he has a relatively long time horizon, not planning to live off dividends for another 2 to 3 decades. Along with that, Neil is investing $800 into his portfolio every single month, and in the notes here he says, first of all, I want to thank you for the amazing videos you create. They have truly inspired me to start dividend investing. Neil, thank you so much, my friend. I'm really happy to hear that. But anyway, he says, I began investing in crypto at age 28 and managed to make around $1.5 million in profits. My goodness. Now at 33 years old, I've been looking for a safer way to continue growing my net worth. 3 years ago, I started investing in dividend stocks, and I've also allocated around $800K into bonds yielding 4%. Very nice. Which brings in approximately $22,000 per year after taxes as passive income. Currently, I have about $200,000 invested in stocks, with another $100,000 ready to deploy if the market dips, allowing me to dollar cost average. Additionally, I invest around $800 per month from my bond yields into the stock market. Okay, so that's where that $800 per month comes from. Now, taking a look at Neil's portfolio here, just as an overview, we can see it is currently valued at a whopping $391,000, which is very impressive. Great job, Neil. And the dividend stats, I think, are looking pretty good too. We're getting a nice 2.2% dividend yield and a near 9% dividend growth rate here in this portfolio. So these are your classic dividend growth stats. And so overall, some pretty solid numbers there across the board. And as we'll see in just a moment, the holdings in this portfolio are also pretty solid. Real quick though, I did want to mention that Neil has shared his portfolio with us here using Snowball Analytics, which is actually the sponsor of today's video. This is a really cool portfolio tracker that I think you guys would like a lot. They're actually running a killer sale right now, and I want to tell you a little bit more about it. One of the most essential tools for any investor is a solid portfolio tracker, and Snowball Analytics is like the Swiss Army knife of portfolio trackers. I've been using this platform pretty religiously to track my own portfolio for a while now, and I can't tell you how impressed I am with how much insight it provides into my portfolio. As you can see, the layout is very clean and intuitive, and the platform overall is pretty easy to navigate. Plus, it's packed with more charts and graphs than you can count, which speaks to just how much data you get, not only for your portfolio, but also at the individual stock level as well. I mean, pretty much anything you want to know about a company's financials or dividend history can be found here within the platform. Now, in my opinion, what really sets Snowball Analytics apart are the features it has specifically designed for dividend investors. I'm actually convinced this platform was made for us, and here are some of my favorite features. First off, Snowball tells you your total returns by default throughout the platform, which may sound like a small thing, but it's crucial for dividend investors because it doesn't neglect the dividend income we receive when calculating returns. Most other portfolio trackers will only show your share price returns, which is really only half the equation, so it's refreshing to see dividends factored into these calculations. Additionally, Snowball has a pretty in-depth event calendar that keeps you updated with upcoming news, dividend payments, and any other important stuff going on. And they even have a dedicated dividend calendar so you can see who's paying you each month, when they're paying, and how much they're paying. Beyond these tools, Snowball also has a community section where you can check out other users' public portfolios to see what others are investing in, which is always a fun thing to look at. Plus, they have stats for stocks and ETFs that show what's trending and what's popular among other investors. This makes Snowball not just a killer portfolio tracker, but also a great place for dividend investors to get new investing ideas. So overall, if you're looking for a great portfolio tracker, which once again is something that every investor needs, then I highly recommend you check out Snowball Analytics, which you can actually do for free. All you need to do is click the link in the description of the video or in the pinned comment, or just scan this QR code right here to get a free 14-day trial. And if you like it, you can save 30% on your subscription right now until July 23rd. So time is definitely of the essence. I really love using Snowball Analytics, and I know you will too. So definitely take advantage of the sale and save 30% 30% on your subscription. Anyway, getting back to Neil's portfolio here, looking at the diversification breakdown, this is a very well-diversified portfolio. There are 2 ETFs in this account which make up almost half of the portfolio, about 44.7%, with the rest of the portfolio being made up of individual stocks and also cash. Neil has a very large cash position. I think in his notes he said there was 100K, but he submitted his portfolio to be reviewed a few months ago. So right now he's sitting at about $43,000 in cash, still a lot of dry powder that he can deploy when he sees those buying opportunities, and it makes up about 11% of the portfolio here. And taking a look at the actual holdings here, Neil's biggest position is going to be the S&P 500 through this fund here, makes up 25.65% of the portfolio, and then he's got none other than SCHD coming in at around 19%. And right off the bat, I really like to see this. You guys know I love me that S&P 500 SCHD combo. This is the same approach that I take in my Roth IRA, so I definitely support that. I think those two balance each other out really well. And then as far as the individual companies go, these should all be very recognizable. A lot of big blue chip companies here and a couple hidden gems as well, like Grainger. I think General Dynamics is a hidden gem. Scrolling down even more, Ecolab, that's a great choice. Sherwin-Williams. And then extending the holdings here, these last two were hidden just a moment ago, but we've also got ADP and ROP, both great companies as well. So in my opinion, not a bad holding out of the bunch. I really like all of these individual companies. In total, there are 25 individual companies here in the portfolio. And normally, you know, if it were another portfolio, I'd look at this and say there are just too many holdings. You don't need this many individual companies since you have such a large exposure to ETFs through these two right here. But because this portfolio value is so large, you know, coming in at almost $400,000, I think it makes sense to be a bit more spread out. I think you can get away with more diversification as your portfolio grows in size. I think it makes sense to be a bit more widespread, especially in terms of where your dividend income is coming from. Also, if we go into each sector, Neil here is very diversified within the sector, so there's not a whole lot of overlap. If we just click here into financials, we can see that all 5 of these companies are different in their own right. BlackRock is an asset manager, JP Morgan obviously a bank, we've got insurance, BDC, business development company, and MasterCard, a payment network, so they're all different in their own right. And that's more or less the case here, jumping into consumer discretionary, just looking at another example. Obviously, both Starbucks and McDonald's are restaurants, and we've got a home improvement retailer, we've got a luxury goods company here with LVMH. So even though there are a few instances in which there are numerous companies in one single sector, I don't necessarily mind that because, like I said, each company within these sectors is diversified in their own right. So, you know, I'm really not left with a whole lot to critique about this portfolio, which is good. But if I absolutely had to be nitpicky about something, I'd probably just go back to what I was saying a few moments ago about having a whole lot of holdings here. Even though the portfolio size is rather hefty, I still think you could make the argument that you don't need to have all of these individual companies, especially since a lot of these are, you know, 2% or less of the portfolio. A lot of these are relatively small positions. So if you were ever interested in consolidating, it would be a pretty easy thing to do. You could definitely chip away at some of these smaller holdings. But at the same time, like I was saying, these are all great companies. It's not killing you to continue holding on to them. You still, at least I think, have pretty decent positions, even though they're relatively small in the portfolio. $6 grand, $7 grand, $8 grand in one position is still nothing to turn your nose up at. All in all, Neil, I think you're building an incredible portfolio, my friend. I'm really inspired by what you've been able to build here. So thank you for that. And also, thank you so much for letting me take a look at your portfolio. This was really cool to see, and keep up the great work. Now, our second portfolio here belongs to my friend Andy, who's pretty new to the investing game. He started investing less than a year ago and has a decent time horizon until he plans to live off dividends. He's trying to get there sometime in the next 10 to 20 years. And every single month, Andy is investing 650 pounds into his portfolio. In the notes here, Andy says, "Been loving your content on my journey to learn." Well, thank you, man. I appreciate that. I'm now 35, and like most, I wish I had started sooner, but there's no time like the present. Amen to that. After much research, these are what I've come up with. Please note that a large chunk of the JP Morgan fund is actually to build toward paying off my mortgage. My main long-term portfolio is 60% in that fund, and the other 40% is split evenly across the different individual stocks. I intend to hold all of these for a minimum of 10 years. But anyway, jumping over, taking a look at Andy's portfolio here, he's also shared it with us using Snowball Analytics, and as we can see, it is currently valued at 20,186 pounds, and I really like these dividend stats. He's got a 2.1% yield and a very nice 11.1% dividend growth rate. That's solid. Now looking at the diversification breakdown, pretty well diversified. The great majority of the portfolio here is in ETFs. It says here there are 2 different funds, but there's actually 3, and in total, ETFs make up 64% of Andy's portfolio, with the 11 individual stocks here making up the remaining 36%. Now with that, if we scroll down, taking a look at all of the holdings, the 3 ETFs in this portfolio are going to be ACWI right here, which as we can see has a lot of recognizable companies, at least here in the top positions. It's a very diversified fund coming in at almost 2,300 different holdings, but the top companies are going to be the likes of Nvidia, Microsoft, Apple, Amazon, Meta, the usual suspects. So it's pretty similar to what you'd find with your typical S&P 500 ETF. So anyway, this makes up 56% of the portfolio. And the other ETF here is JGGI. This is the fund that in his notes he said he was using to build up the money that he was going to use to pay off his mortgage. And once again, we're going to see some very recognizable companies here in the top position: Microsoft, Amazon, Meta, Nvidia. But then we've got some others like J&J, Southern Company, McDonald's, all in all still good companies. And then if we scroll down just a little bit, the third ETF in this portfolio is actually SGLN right here, which is just a physical gold ETF. So he's looking to get some exposure to gold. Not a large position, less than 2%, but it's still there. Now, outside of the ETFs, we should recognize all of these individual companies. We've got Blue Owl, VICI Properties, Legal & General, scrolling down, Realty Income, the usual suspects right here, ASML, we've got Visa, UNH, and then Novo Nordisk. So all great companies. And all in all, as a new investor, I've got to say, I do like the makeup of this portfolio. We've got the bulk of the portfolio in ETFs, and we've got a small handful of individual companies on the side. I think that's a pretty solid balance. Now, with that said, with 20,000 pounds invested, 3 ETFs, 11 individual companies, I don't know that I would diversify any more beyond what you've got right here. For this portfolio size, once again, around 20,000 pounds, I think this number of holdings is more than enough. And playing devil's advocate for just a moment, there does look to be a little bit of room to actually consolidate out of some of these holdings. And for that, we're going to look to none other than Alphabet, Microsoft, and Nvidia. You could make the argument that you don't need to own them individually since you already have such large exposure to them through ACWI, which once again are some of the top holdings in this ETF. Nvidia's number 1, Microsoft's number 2, looks like Alphabet's down there in the 7th spot. With that said, it's not going to kill you by any means to own these companies. Like I said, they're all great ones to own. And overall, Andy, I think you're doing a great job with this portfolio. Thank you so much for letting me check it out, and keep up the good work. Now our third portfolio here belongs to my friend Jason, who's been investing for somewhere between 1 and 5 years. Jason has a relatively long time horizon, not planning to touch his dividends for another 2 to 3 decades. And in the meantime, he's investing $100 to $200 every single month. Now in the notes here, Jason says, I've been investing for 3 years, but became more serious about it over the past 2. I'm currently 21 years old, studying finance in college, and have no student debt. Great job, Jason. That's awesome. During the school year, I contribute $50 per week to my portfolio, and I'm able to invest $10,000 from my summer job earnings, which is between May and July, on top of what I already do weekly. And man, I've got to say, that is so awesome. Great job getting started with investing so young, and also for being so responsible with your finances. You're doing great. With that said, guys, I feel like I've been noticing a big shift lately. I've been seeing a lot more younger people starting to get interested in investing, like Jason here. And my little brother, who's 18 years old, is also just now getting interested in investing at 18. And I'm super happy to see that, obviously. And any of you young guys out there, maybe in your early 20s and your teens, I want to hear from you guys in the comments. Is investing starting to be like a cool thing to do? Are your friends starting to get interested in investing as well? What's the deal here? What is going on? Any insight that you guys might have, I want to hear all about it in the comments below, because this is really interesting. But anyway, now looking at Jason's portfolio, once again, it's over here on Snowball. And as we can see, it's valued at $11,300. 21 years old with $11K in the portfolio. That is awesome, man. And looking at the dividend stats, we've got a 4.4% yield here with a 4.6% dividend growth rate. Interesting. Now, my knee-jerk reaction looking at these dividend stats is that, to me, just at a glance, based on Jason's age, based on his investing time horizon, another 2 to 3 decades to live off dividends, I like a 4.3% starting yield. That is a nice yield, but I would have preferred to see a higher dividend growth rate. Even if that meant the starting yield had to be lower, I would have rather seen a dividend growth rate closer to 8, 9, 10%, or even higher than that. But let's dive a bit deeper here into the portfolio to see what we're rocking with. And as we can see right off the bat, there are 7 different ETFs here in the portfolio, and they make up about 58%. Now in total, there are 18 holdings, which means the remaining 11 are individual stocks, which make up the remaining 42% of the portfolio. And scrolling down, just doing a little roll call here, the 7 ETFs are going to be SCHD, which is the largest holding, VUG, which makes up almost 16% of the portfolio, JEPQ, a nice high yield covered call ETF. Scrolling down, we also have VOO, not a large position, 2.8% of the portfolio, VHT, which is the Vanguard Healthcare ETF. And then we also have MSTY here, which is a Yield Max ETF. And then outside of the ETFs, looking at the remaining holdings, all the individual companies here, these are all great. I mean, like the last 2 portfolios, I think all of these individual stocks are great picks. Now, right off the bat, the 2 things that I like about this portfolio are, number 1, I like how heavy it is in ETFs, about 60%, with the remaining 40% going to individual stocks. I think that's a fine balance. And number 2, like I said, I like most of these holdings. I like all the individual companies. I like most of the ETFs except for one. Not much of a surprise, I'm sure, but I really just don't like MSTY, and I just don't like the yield max funds in general. And in your case, Jason, I'm still not a fan of it, but fortunately, you're a young guy, 21 years old, and you can afford to take some risks on stuff like this if you want to. And also, I mean, you only have about $180 invested in this fund, so even if it went to 0, it's not going to be the end of the world. You're going to be just fine. Now, that aside, the only other thing that I would change about this portfolio is I don't think you need to own both VOO and VUG. And also, scrolling back down, I don't think you need to own VHT, but we'll talk about that one in just a moment. Starting with VUG and VOO, I just think there is too much overlap. We can see there's about a 60% overlap between these 2 ETFs, and the great majority of VUG is already in VOO. 80% of the holdings in VUG are already in VOO, so you're double dipping in a lot of ways by buying both of them. And as we can see, looking at the top holdings, this is VOO right here. It's going to look very similar to what you'd find here with VUG. It's the same suspects. We've got Microsoft, Nvidia, Apple, Amazon, Meta, Broadcom, Alphabet. They're all there. So once again, I think it creates a bit of redundancy by owning both. I think you could just choose to invest in one. It doesn't really matter which one either, whether it's VOO or VUG. You'll be fine either way, but I just don't think you need both. Now with VHT here, fine ETF. But in my opinion, you already have enough exposure to the healthcare sector through NVO and also through UNH right here, both great companies. So since you already own these 2, I don't think you need to own VHT. I don't think you need any more exposure to the healthcare sector. Or do it the other way around, just hold on to VHT, but don't own UNH and NVO. Either way, I don't think you need to own both those individual companies and the sector-specific ETF. No matter what though, Jason, you could be doing a whole lot worse, my friend, and I guarantee that if you just keep doing what you're doing over these next 10 years, by the time you're my age, you're going to be a very wealthy dude. So keep up the great work, and thank you so much for letting me review your portfolio. It was cool to check this out. But anyway, guys, those were our 3 portfolios of the day, and if you want to see inside my portfolio and see how much money I've made with dividend investing so far, then check out this next video right over here. I've been investing for about 5 years now, and in this video, I'm breaking down the performance of my portfolio, and I'm sharing all of the dividends that I've received up until this point. So click right over here to check that out, and I'll see you in the next one.